Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to Live Squawk's Market Talk Weekly. This is where we try and break down the key stories of the week gone and the implications for the markets. We'll also take a look at the week ahead, and we'll try and give you a heads up to what you should be looking out for. I say we because every week I'll be joined by a market expert in their field. On this episode, I'm joined by regular contributor and long-time trader Jamie Dutter, friend of the show and contributor to PIQ, a news aggregation platform. Jamie's been in the market some 30 plus years, and I laugh because we're the same age and we've been around for such a long time. And he has a vast array and amount of experience within the industry, having worked for some of the largest institutions out there. Hi, Jamie, how you doing?
I'm very well, Harry. It's very nice to speak to a fellow seasoned professional like yourself. No, I'm very good, thanks, mate. And thank you for inviting me on, for sure.
No,
yeah,
always a pleasure to have you on, my man. Right, just before we get into the reads, just a quick note and a bit of housekeeping. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. Okay, with that, let's get into it. This week has been another one of those bizarre weeks where we've had all sorts of stuff going on, and we will come to the I guess the biggest event of the week, really, or the funniest event of the week, i.e. yesterday, President's
trip. No, it's not that one. Was it that one?
Yeah, well, yes, his trip to the Federal Reserve and their new
hard
building.
Hats at the ready.
Hard hats. We'll need tin hats as well as hard hats for that one. But I want to get into what we've seen over the course of this week. And I want to go back, because it seems like a million years ago, to the start of the week, or Sunday, to be more precise, and Japan's upper house elections, where the LDP coalition lost its majority in the upper house election. And again, a lot of that was built into the price. But and so we've seen, maybe you buy the rumor, sell the fact sort of play out for the yen and for JGBs. But it does open the door now to more questions, i.e. will Shiba, the current Prime Minister, last beyond August? That's one of the other points here. And also, will the Bank of Japan move on rates? According to headlines late in the week, BOJ sees no urgency to hike at the moment. We've also had, again, as I said, Japan's PM Shiba may resign in August. Another one of the speculative headlines out there. He wants to stay in and make sure the job's done. Obviously, they've got the trade deal over the line. That was one of the other proclamations, that a Japan trade deal's been done, been agreed between the US and Japan. A 15% tariff deal was apparently sealed, says Trump during the week. And again, we had an ECB rate decision. They left rates unchanged as expected amid fear and expectations in Frankfurt. So, and then we get to the hard hat story and Trump's visit to the Fed. Some say to try and angle a way to accuse Fed Chair Jerome Powell of overspend on the building, and given then due cause and a base for dismissing him. He said Trump himself has said that's not the case. Officials said that's not the case. They just want a different chair, and they'll get their wish in 10 months when Jerome Powell is set to step down. Yeah. Jamie, what are your views on the week? What are the stories you're looking at, or you've looked at over the course of this week, and that you think are influential and important?
Yeah. Yeah, I mean, definitely Japan, obviously in the headlines for various reasons. Obviously the trade deal, and then obviously the political situation, I guess, and then the ECB as well, with Trump underpinning everything really. Relief trade, I guess, on the US Japan deal. Some skepticism on the detail, I guess. 15% on imports and autos, but still 50% on steel and aluminium. And then there's sort of token purchases about US, agriculture type thing. And it was all about rice, if you remember, and Shiba was holding out. And then all of a sudden he's not holding out. But I think overall, that is very much unchanged. Japanese quotas on rice imports, which was probably the major sticking point anyway. But, big, decent relief rally. As you say, the yen actually strengthened, which was surprising to many after the election, with so much uncertainty sort of coming from that at some point. And we've sort of seen that taken back, as you said, the last couple of days in dollar yen anyway. I guess from that political point of view, it probably means, there's still that focus on debt sustainability in Japan, and it probably makes it probably more difficult to implement reforms, that aimed at boosting domestic demand and stabilizing inflation at target. I guess that's the issue. If Ashiba goes, or when he goes, possible replacements. I think I've only sort of read about, is it Takaichi, who's very conservative. I think she, is against sort of women keeping their maiden names, that kind of thing. But
ironic that she could become then the next leader of the.
And the LDP, right? So, I think potentially she's against Bank of Japan hikes. So, it's interesting, obviously, then getting the meeting, Bank of Japan meeting next week as well. So that's sort of from the political point of view. Obviously, the trade deal we've just talked about, and the relief rally really in stocks, in risk assets, really on the back of that, which I think was interesting, because we kind of knew something was happening, but there's so little detail on these. I think is interesting always, but markets don't really care, and it's the same with the EU possibility, that we've had all through this week, which was probably a slight surprise, because obviously, the EU are sort of getting together 93 billion or whatever it is of tariffs, on August 7th, I think, in preparation for 15% to 30% ramp in tariffs on EU goods. So,
but there is a division amongst EU members, I think, in terms of whether they should implement this or not, whether they should try and work or suck it up and basically put it this way. If you'd said back in March, before April Rose Garden event, that 15% tariffs would be applied, and the market's not going schizophrenic about it, you go, I don't think that's not going to happen.
Yeah.
But we've now accepted 15% as the likely tariff, as potentially the tariff level. And the markets aren't dying. In fact, we're near record highs for some of these markets now. In the space of 4 months, 5 months, would you have contemplated that as an outcome?
Well, I think it's because he went so, gangbusters, if you like, with triple digits.
Which is genius when you think about it.
Yeah, absolutely ridiculous. And, market convulsed. And it was just, even with the board in the Rose Garden, those levels were ridiculous. But that's, we've said it before, right, Harry, this art of the deal, whatever you want to say, and then you come back down, and then he can, I think tariffs were 2.3% before Trump took office, right? So he can say to his base and to his supporters, 15% is a crazy win, right? Or anything above that. And I think now, it's like 14% on all goods and services, 17% on goods. So, if we're getting around those numbers from what we were, whether that is the ultimate goal and how much that raises, ultimately, I think is a longer term question, but it adds to that sort of equation that they're looking at potentially, or meant to be looking at, then I agree. 15%, but we're talking because they were 30 plus, so maybe succeeded, in sort of getting our we're then happy with 15%,
You can't argue it. I mean, let's be honest, that if that was his plan all along, he's executed it like a demon.
No, absolutely. I listened to a very good podcast with and I can't remember who it was with, but they marked Trump out of 10, and they were very unbiased, and they sort of gave him an 8 or a 9, for his first few months in office, and for appealing to what he said he was going to do and to his base, definitely can't argue with that. Absolutely,
No,
right? You know,
no, absolutely.
so yeah. And you know, that sort of leaks in then to the August 1st deadline. I mean, everybody wants to take the mickey, I guess, and the taco trade is exactly that, right? And we've had 3 deadlines put off, I think it is now. So the August 1st deadline, do we really care? You know, we don't really care. It's status quo that it will be moved. And we sort of talked about it briefly, didn't we, off air, that
Sure.
in fact the China deadline is August the 12th. And I think Besant this week has said, well, we could give them a 90-day rolling deadline. So then there is no deadline really. And, you know, we just want to shout about triple-digit tariffs, then becoming, you know, less so, whatever they'll be, 20, 30%. But we're dealing with China, who is our ultimate, you know, competitor, I guess.
Yeah.
Fascinating. So long question, long reply to your answer. But others aside from that, obviously ECB important to us all. Interesting, really. I guess she was less dovish, obviously. Lagarde quite relatively optimistic for her. Interesting, she dodged the sort of any questions about the euro, kind of downplayed that inflation undershoot that everybody's worried about, possibly with the euro going higher. And even those June star projections actually already predicted a minor undershoot anyway, actually. So that's probably where she's coming from. And the fact that relatively it's, you know, as she said, in a good place of sorts, you know, resilient-ish economy. And
Well, I'll give you a quick note on this. Is from Deutsche Bank, and they assessed yesterday's ECB meeting.
Yeah.
We're recording this on a Friday afternoon in London on the 25th of July. And so yesterday, the ECB meeting, and Deutsche Bank said more hawkish than anticipated, focus on medium term. Lagarde did not rule out the next move being a hike. So with that in mind, we also got a sources story out, I think it was yesterday as well.
Straight after. Yeah.
ECB policymakers set high bar for a September rate cut. I mean, I think at its highest, it was priced at around 41%. It's now down, I think, into the teens, if I'm right. Set cut would require a deterioration in data and lower projections, is the sources story. So you can already see them starting to manage expectations for September.
Yeah,
really.
And the services PMI as well, didn't it? Came out yesterday as well, better than expected, and that sort of lines up possibly Q3 being fairly solid as well. You know, meeting by meeting, data dependent, all that stuff. And I can kind of, you know, if German fiscals, you know, kicks in at some point, then we won't be talking about cuts. We'll be talking about something else. So we pause in September. I think it was 50-50 sort of thing, coin toss, wasn't it, for the rate cut September? So that's down to is it even teens now? So it was less than 25%. So you know, interesting spot for the ECB, which generally, you know, gets slightly sort of castigated, doesn't it? But you know, do they do an insurance cut, I guess, is the point. You know, if a deal isn't forthcoming in some way, then do they do an insurance cut? I don't think they do, really. I mean, 2% is slap bang in the middle of the neutral, you know, 1 3/4, 2 1/4. So
they've tended to be slow in the past with any action they've taken. So who's to say they wouldn't take it again? Just quickly, I'll touch on UK borrows billions more than expected as debt costs surge. There's an issue now. FT wrote a piece actually today that suggested that there's very little room now for UK Finance Minister or Chancellor of the Exchequer Rachel Reeves to enact any kind of policy without tax hikes. So, except for the rich, apparently, because that's been denied that they will hike taxes for the rich.
Yes, I think it's really interesting. This, I mean, sorry to interrupt, mate.
No, go on.
We knew about this. So when we had Rachel Reeves, and again, she gets absolutely, you know, sort of maligned excessively, you know. So when she had that moment in Parliament, and you know, markets sort of didn't like that very much, and then obviously they backtracked and it wasn't about that, and you know, but surely we know that something is going to have to happen in the autumn budget, and probably tax cuts. Everybody knows that already, but then the market did react about that little sort of, you know, episode, as it were. So I think it's interesting. And then, and sterling's getting it today. And I think the contrast in a way between the ECB, you're getting euro. I'm just looking at euro sterling actually above 87 now. So it's broken higher. Quite a nice pattern technically. And you just get that contrast between the ECB, quite interestingly, that resilience and the pickup in business investment, especially contrasting with the sort of fiscally massively constrained UK economy.
There's a divergence. There are divergences all over the place now with the G7 and interest rates, I think, starting to form.
Yeah,
maybe at the beginning of it, but there appears to be some sort of divergence.
And it feels like sterling. I don't know. You can tell me, mate. But everybody wants to short sterling. Because they know that. I think it's November 5th might be the budget day now. I read, but that date, everybody knows that she hasn't got any headroom anymore, so she has to do something. I don't know. Interesting. So do we not get that reaction before November 5th?
Absolutely. I mean, listen, when you got Kwasi Kwarteng, former chancellor, just saying he was speaking on Al Arabia English.
Yeah.
He was saying that he's under a lot of pressure. He should know as to Liz Truss in the information. Lettuce days. 42, was it 42 days?
Yeah, I think so.
I think it was even less. He likes it even less than that. But there we are.
Yeah.
I want to move to the week ahead.
Yeah.
And, because if you think last week was busy, you ain't seen nothing yet. So if we go over some of the key bits from the week ahead, you've got US set to impose a 30% tariff on EU goods if no agreement. We've heard in the recent minutes that they're likely that some EU sources have said we could come to an agreement over the weekend. Details to come on that, so we'll have to wait and see. But that would again quell a lot of concerns out there, but also heighten a lot more in terms of where it sends inflation, where it sends prices, and where it sends activity, I guess, in the short term. If we're not looking toward the medium term, we're looking for the immediate future. Also next week we'll have Eurozone headline inflation, HICP expected to soften due to base effects as well. So I mean that would then obviously ease some of that near-term pressure. Wouldn't. It would do the opposite actually, because then it would put a bit more onus on September again. But we'll wait and see.
I think it's going to be pretty benign, isn't it, really, this report? Maybe services up and goods down sort of thing, by all accounts.
Right.
Yeah. But around that 2% level, right?
We'll have a plethora of Eurozone, a G7 growth numbers out as well.
Where's your graphic? Come on, where's your graphic?
The graphic says... the only other graphic I've got was that one. No. I was going to get a graphic of. I'll come back with that in a minute. But in terms of the G7, the number of G7 countries is set to report on GDP, so that's going to be something I think we'll have to look out for in what is an already a jam-packed week for everything really. If I can, I'll tell you what I'm going to do. I'm going to share my screen because that'll work. Let's see if I can share my screen. Right, this is the HSBC. Global economic calendar, and just a quick look at Wednesday rather, and you've got France flash reading, Germany, Eurozone, and we'll have US GDP numbers, the first look at the US GDP as well for the period. I think the consensus is for a growth rate of 2.5%, HSBC going for a slightly higher number as well on that. So that's something to look out for as well. Let me see.
Yep.
I should actually probably share it so you can see it.
Oh, there we are. Yeah.
There we are.
You got it.
So as you can see, there's a fair amount out next week on that front. And then you've got, as I said, all the prices data. And we do have obviously core PC price index out as well next week. But I must admit, with CPI that's released, the headline CPI, it kind of everything's sort of calculated beforehand, I guess, on that one. So what you get is what you get with the core CPE nowadays, PCE reading, and it pretty much is accurate according to calculations done by a lot of these analysts out there. So one to watch. Obviously, the headline event for next week will be FOMC rate decision on the monetary policy front. We do have a Bank of Canada rate decision as well to bear in mind. But yes, FOMC on Wednesday. And what are your views on that? They're looking to keep rates are expected to stay unchanged, really. So no big whoop on that. But what are your views on FOMC next week?
Yeah, I mean, there's that classic wait and see stance, isn't it? I'm afraid, especially through the summer. I think Powell said we all know CPI sort of got impacted slightly by tariffs, but not that much. But we know that the next few months will potentially feed through. So July, August, September CPI feeding through. If that ticks up, then 0.4, 0.5 possibly. Then they will not cut rates in September. I think there's around 16, 70 basis points priced in at the moment. So I'd be surprised if they do. I think the August report is September 11, and then I think the Fed is September 17. Don't quote me, but I think that's right. So I'm kind of would be surprised if they go, yes, just with the data expected to tick up, the CPI data. That's sort of the view, although they'll just sit on their hands, through this meeting. And Trump will get very irate, and potentially they will hold on further or through September, October, possibly as well. I mean, the concentration of, I don't know whether it's headlines or whatever, on Waller and Bauman, compared to the majority, it might just be me, and I've got some sort of search function with just those two, but they seem to be very much louder than everyone else, or is that's just the media reporting it? Whereas everyone else on the FOMC is not thinking what they're thinking. So, and I think as well, do we definitely probably have to bear in mind the transitory issue, right? Of post-pandemic supply shock, price hike, inflation up to 9%, and therefore they're gonna make sure that doesn't happen again, before they act. So I think we should bear that in mind as well, which sort of then, for me as well, then, September doesn't really take place and they sit on their hands for that meeting as well, I think.
Let me just give you some dates then. So we know the next meeting is next week. 29th, 30th is the two meeting days for the committee to sit, the board to sit. Then after that, September 16th, 17th, that will be one that includes a summary of economic projections. So we get updated projections. Typically, the markets favour movement, or if there is to be a move, around those economic projection dates. But as many times we've seen it, we've not seen any action as well on those times. Then after that, October 28th, 29th, and then the last one of the year is in December 9th and 10th. And again, that will come with the summary of economic projections. So I've got a note here from HSBC, and they cover both the PCE data, but they say in terms of the CPI, or PCE rather, given inputs from CPI and PPI released earlier this month, we expect both total and core PCE to rise 0.3% month over month, the latter being the Fed's preferred inflation measure, and this would translate to 2.6% annually and 2.8% annually, respectively, for both. Meanwhile, the Fed is likely to keep its Fed funds target range at 4.25% to 4.5%. As tariffs kick in, HSBC anticipated them to be inflationary for US consumers and expects the Fed to remain on hold until labour market deteriorates further. As I said, we have non-farm payroll on Friday, and the July labour market data for the US will also be released, and they are looking for non-farm to increase at a slower pace of 130,000, down from 147 in June. So again, at the end of the week, then to bookend the week, you've got US non-farm payrolls. Jamie, any views on the jobs data and how much of an influencer it is on Fed officials at the moment?
Yeah, I mean, I think they've said, the labour market's still in a good place. Everybody then expects it to slowly deteriorate, I guess, and there'll be further, sort of gradual deceleration in job creation going forward. But at the moment, I can't remember. I think the whisper's around 110, isn't it? And the sort of 3 month and the 12 month average has been about 150. So that's kind of consistent with still a stable, labour market, really. I guess going forward, if we get sub 100 prints over a few months, then that potentially is deterioration. But then whether the unemployment rate does rise higher, I think it's 4.5%, isn't it? The Fed's projection at the moment, I think it's projected to go to 4.2 this time on Friday. But do we get slower sort of labour force growth because of falling immigration? I think, and then potentially that impacts unemployment. So as in it won't rise as much. So good place labour market, and it'd just be a surprise if it's sub 100.
Okay, so and to be fair, there's not really a lot that's gonna really materially change the likelihood of the Fed moving at the moment. I mean, as you said, as we talked about, they are getting trade deals across the line. There's expected to be a number of officials have said we'll get a number of deals done. And Trump has actually said today that not only will we get some deals done before August 1st, but some of these might be done via letter, i.e. they'll have to accept what's been given in the letters that have been dished out already on that front. So it's really
I think we move on. Do we move on soon from tariffs? Is that too optimistic? We moved on from geopolitical issues, right?
Yeah, I think so. I think we've got to a point where it's no longer the market mover that people think. I think it's
totally.
It's got to the point now where you've got to start looking beyond that to the fundamentals.
Yeah.
Again, because all this panic, there was a lot of panic derived from Trump's messaging predominantly, but at the moment, you can say the impact has been marginal, not minimal. I'd say marginal in terms of the inflationary effect, and that may kick in down the line. You don't know, and also to economic activity. Well, even if we come in at 2.4, 2.5 for growth next week, that's hardly meager. I mean, it's probably not as strong as they want it to be, but it's hardly poor, is it?
Yeah. No, I think one other interesting thing, Harry, I think for me is that how the street, I guess, have sort of moved from this inflation shock to now, and I think I was saying it a long time ago, and it was just like tariffs last time around in 2018, 2019, and it's this one-off price adjustment, which now I'm hearing a lot of, and a one-off price, price adjustment basically, like a VAT sort of adjustment, which now I think a lot of people are talking about. And therefore, the Fed will look through that after a few bumpy months of possibly high, as we said, high core month on month. But then they'll look through that and then look at the labour market, obviously. Whereas before, everybody was, inflation's going to, 4.5% or whatever it's going to be, So, I'm surprised it's taken, I don't know, maybe, as we've said, the shock has dissipated, and now we realise it's just this one-off price adjustment, and then we move on, like you say, and we move on to possible Fed action, although I'm not sure, and then sort of deregulation and the next bit of agenda that Trump's got lined up for us, apart from the hard hats.
Apart from the hard hats, well, I've just put this is the cartoon up there from Cleveland.com, and it's just. Again, the satirists must be having a field day with everything that's going on at the moment. But it all brings a bit of fun to the markets and a bit of activity and volatility. So I'm not complaining. With that, I'd like to round it up then and just say just a thank you for your participation today, Jamie. Always
thank you for having me very much, Harry. Yeah, great to be on.
Awesome. And anyone who wants to listen back to this recording, it'll be up on the major podcast platforms, or you can go to the social media, go to X, or LinkedIn or Facebook, and you'll find us there if you want to have a quick listen back to the whole recording. But again, over the weekend, we'll publish our week ahead with some bank research about what to expect from the numerous amounts of data we have out over the coming 7 days. So take a look there at livesquawk.com for that over this weekend. But thanks again to Jamie, and guys, have a great weekend, and we'll be back and see you next week. Have a good one. Bye.
Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.